Hello and welcome to Livewire's Fund in Focus. My name is Chris Conway. Today I'm sitting down with Roy Keenan from Yarra Capital Management. Roy is the co-head of Australian Fixed Income, and today he's going to be talking to us about his Enhanced Income Fund. Roy, it's great to see you again. Thanks for sitting down with Livewire.
I love catching up with you.
Appreciate that. Roy, tell me about the Yarra Enhanced Income Fund, your baby for more than 20 years. What's in it? And who is it for?
Yeah, we're fast approaching 23 years. So look, it's a fund that we started many years ago to produce income, a really consistent income for our clients. We try to generate a return 230 to 280 over cash pre-fees, pay monthly distributions, and what it's done and designed to do 2002, it's delivered. That's the pleasing thing about the fund.
Yep. So you touched on it there. The primary aim of the fund is to deliver consistent income holding a blend of high yielding fixed income and hybrid securities. Just unpack that a little bit for us.
Yeah, so we invest right across the capital structure of corporate Australia, whether it be banks, insurance companies or corporate credit. We don't look at structured credit within this fund. We leave that for another part of the investment universe. What we try to do is we're always looking for risk-adjusted returns. Mm-hmm. So it can be in senior credit, it can be in subordinated credit, corporate, whether it be corporate or major bank or insurance corporate debt. What we try and do is find a blend. We try to maintain a fund which is always investment grade on average at the credit rating level. So that's really important. We're not taking a lot of credit risk and we're trying to keep it as much quality as we possibly can.
Yeah. Roy, just tell me the current yield of the fund.
It's just under 6%, about 5.9%.
That's pretty healthy, yep, good stuff. Roy, now the economic landscape, it's always changing, as you would well know, causing different bond sectors to go in and out of favour. What has been working over the last 12 months and what hasn't?
Yeah, it's been an amazing, volatile 12 months. Yeah. So when we look at investing in credit, we're also taking that macro environment and trying to generate returns from our interest rate strategies, our curve positioning, trying to pick our security selection correctly, and also in some ways capturing the credit spread, any credit spread rally that might be on offer. So when we're thinking about all those things, and I look back over the last 12 months, Trump's Liberation Day in April provided a tremendous opportunity for us, because in some ways that 12-month outlook that we were looking for, we got paid off in 1 month because the volatility was so great. We were able to realise our curve positioning, our interest rate strategy, but also then deploy cash at elevated levels for credit spreads. So it has been. If you look back over the last 12 months, the RBA is going to ease 7 times. All of a sudden, it's not going to move. It's been that sort of very volatile period that's created a lot of opportunity for a manager like us. Yeah.
So just the nuts and bolts, Roy, how has the portfolio shifted tactically over that period? Just some of the weights over that 12 months.
Yeah, so we had our interest rate duration, for example, at about 1.7 years. There's been times this year we've taken it back to about half a year, back to a year. And it all comes down to, what's our view on how many times the RBA will cut rates? Are we being paid for that? And if we have been paid for that, then let's get out of there, right? Let's remove the risk and re-add it in when the market has changed its view, which may be different to what our view of the marketplace, is. It's been that sort of market. It's really helped us to hone in and get the best risk-adjusted returns as possible.
Yeah, Roy, I know most fund managers are never 100% happy. Is there anything that you think you could have done better over the last 12 months?
Absolutely. With just the previous question, the yield curve, for example, we had a steepening yield curve view on, which we've had for probably 2 years now, and in April, the yield curve went from about, I'm trying to remember now, 70 basis points and probably topped out at 130.
Right.
I got out far too early at sort of 112 to 113. It was a great trade, but
because you're pretty hard on yourself, mate. You got most of it.
It was very volatile, right? But you look back and you go, what could you have done better?
Sure.
And in some ways, even the recent, when the market started to talk about the RBA wasn't going to be as aggressive off the back of July's non-rate cut, there was probably opportunities to increase our duration again. We set our levels and it didn't quite get there, but you sort of always, Harry hindsight's always very easy, but you do try to pick your levels and try to maximise that as possible.
Yeah. Where are you finding relative value now?
We think that tier 2 is still the place to be. Major bank tier 2, A-. It's hard to find better value in that A- space for major bank tier 2 at the moment. I know credit spreads have rallied, but we still think that's a really safe place for the environment that we're seeing at the moment. We also like corporate hybrids.
Yep.
We have been definitely lifting our weight from about 8% last year to about 18 to 19% today. I could see that keep rising up to 25% over the sort of coming 12 months, especially as new issuers come into the marketplace.
Yep. And do you put any caps on the portfolio? Is there a maximum that you're allowed?
Yeah, absolutely.
Yep.
So the way our portfolios, the fund's designed, it's all about risk management.
Yep.
So we have maximum credit limits for the rating band credit limits, and we also think about trying to find the right balance in our sort of capital structure allocation, whether it be senior, corporate sub-debt, major bank sub-debt, or major bank senior.
Yeah. Roy, we're at the nuts and bolts stage. Anything else that investors should be aware of in terms of liquidity, distribution, frequency, things like that?
Market's really good at the moment.
Yep.
Liquidity, this fund, has daily liquidity.
Yep.
We run our fund with about 4 to 5% cash. I'm running cash a little bit more elevated at the moment. I think there's potential for, sort of another bout of risk off. So we pay monthly distributions. Really, if you go through our history, really consistent distribution payer. Never missed a distribution in 23 years. And I think what's pleasing from a return aspect, and probably one of the things we're most proud of is that, we designed this 23 years ago, and the fund's returned exactly what we designed it to do. And I don't see an environment where that'll change. Yeah,
fantastic consistency. Well done. Roy, last one and an important one. Where can investors find out more about the fund?
Yeah, the best place to go is to our website, www.yarracm.com, or speak to their financial advisor.
Roy, it's always a pleasure having a chat. Thanks for sitting down with Livewire.
Always great to be here.
If you enjoyed that interview as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.